What can entrepreneurs do with a big tax bill after a great year with the business? The first thing is we need to know that that big tax bill is coming. Look, on a day-to-day basis, you're focused on the blocking and tackling of the business, operations, sales, people management, maybe some additional product lines or what we're going to develop down the future. But what you need to have every single year, at least one time a year, is a tax projection completed. And that tax projection is going to tell us, all right, here's how the business did. Here's what it means on the personal side as well. Here's some decisions we can make to turn a very big tax bill into a big tax bill. So doing that projection, getting out ahead of it and making some decisions, that's a very beneficial thing in what we can do so that we're not surprised by that big tax bill. The second thing you really got to focus on this is within businesses, sometimes you'll land a major contract and it's a 1 year pop. Okay. So income's going to shoot through the roof in that given year. That's what we kind of call a tax bomb. It's a high tax year, great year for income, but also a really bad year for taxes. In that year, we need to understand that the following year, your estimated taxes most times are based upon what you earned the previous year. So if you have a year and the business typically does $500,000, but then you're going to do $1 million, and you're going to go back down to $500,000, you need to have your estimated taxes based upon that $500,000 for the go forward. Otherwise, you're essentially paying much too much money into estimated taxes, which is just an interest-free loan to the federal government. The third and final thing is after a really good year for taxes, it may take an opportunity here for you to sit back and reflect and say, all right, where's the business at right now? What are we going to do on a go-forward basis? How do we position things? And that really comes into play with a 3-year tax projection. A 3-year tax projection is very different from a 1 year. On a 1 year, we're doing that in the fourth quarter. We can really start to nail that down. We have a good idea as to where our net income is going to land at. But on a 3-year, we say, all right, if growth continues this way, expenses do this, and we make these decisions along the way, what do taxes look like? And that may open up the conversation for some tax planning opportunities, whether that's purchasing additional equipment to, get the depreciation from it and save you on taxes. Do we look at some charitable gifting? Charitable gifting through a donor advised fund where you make the investment in year one. You get that tax write-off in year one, but you can advise on how the money is charitably gifted into the future. So you give kind of 10 years worth of donations in year one, you get that write-off in year one, and then you make those donations down the road. Do we look at a retirement plan as well? Whether that's a 401k or if you're kind of later on with your career, do you look at a cash balance plan, which is a defined benefit plan? You can save hundreds of thousands of dollars per year. Depends on the entity and how you're set up with the business and your employees. Another opportunity for us to take a look at here is your entity structure. It's unlikely that you're in a C Corp, but if you were a C Corp, should you be flipping to an S Corp or should you be an LLC partnership? How should you be structured within these different types? That'll depend upon what taxes look like, not just this year, but on the coming years. And the final thing is, if you're coming closer to retirement, the business continues to ramp up. We see this very often. We'll see businesses do really well at the end of someone's working career. That means that taxes are going higher and higher. Do we need to be thinking about doing some minor partial Roth conversions here in years 1 or 2 when you're in a lower tax bracket? Remember those marginal tax brackets, you can fill it all the way up and say that you pay the same tax rate. And so by doing that, we may look and say, all right, look, let's do a Roth conversions of $20,000 or $50,000 because we're in that same tax bracket. In the future, we see ourselves being up in higher tax brackets. So again, as a reminder, when we're thinking about what to do with a big tax bill, the 3 things we want to do is 1, a tax projection where we can turn a very big tax bill into a big tax bill. 2, our estimated taxes, correct, for this year and going forward. And the third one is looking at a 3-year tax projection where we can start to involve some more advanced planning techniques where you get tax savings both today and well into the future. Thank you.